Well, futures are indicating a lower open this morning, but the S&P 500 is up close to 40% since its March lows. So are we at a turning point in the markets and the economy? Our next guest thinks so. We are joined by Scott Meinhardt. He is the Chief Investment Officer of Guggenheim Partners, which has $100 billion in assets under supervision. Now, prior to joining Guggenheim, Scott oversaw fixed income credit trading at Credit Suisse and headed Morgan Stanley's London-based European Capital Markets Products Group. We are pleased to have Scott with us dark and early here in the office. Scott, thanks for coming in. Now, you say we are at a so-called inflection point. You see that the latest job numbers for you are reason to be optimistic. The flip side is somebody would say, how can you say that? I mean, we're at a 25, 26-year high with unemployment, and a lot of economists say it's not going to turn around until at least the second half of next year.
Well, Deidre, there are a couple of things. First off, virtually every recession since the Second World War has ended 18 months after the Fed began cutting rates. The Fed began in October of 2007. Now it's by the clock, that would be April of 2009 to see a beginning of a recovery. A lot of people think it's different this time.
I was just going to say that. People have said this is unprecedented.
Well, that's right. And a lot of the stimulus is unprecedented. And so I'm willing to give the benefit of the doubt to the naysayers. But even based upon that clock, and then on top of that, a lot of the indicators that I typically look at, things like consumer sentiment, begin to bottom about 3 months before the end of the recession. We've seen a clear turn up in a lot of those numbers. The employment report and the turnaround we got in the jobless numbers is typically indicative of the beginning of the bottoming process. And unemployment, which a lot of people point to and say, well, you know, look, it's going to go a lot higher, and I agree with that. Unemployment is traditionally a lagging indicator, so that if we see the recession end here, let's say late in the second quarter, early in the third quarter, I wouldn't expect to see unemployment peak until maybe the end of the third quarter or the fourth quarter, and very likely to approach a number around 10%. So nothing bothers me in the naysayers' comments.
Okay, so that's maybe a look at the economy, but as for the markets, a lot of bear market investors we have here say this is a bear market rally. You disagree?
Right. I completely disagree. First off, you know, bottoms are always made when nobody believes they're happening. Secondly, if you look at the data, again, like the expansion of margins, just a simple rule that I look at is producer prices versus consumer prices. Consumer prices have collapsed nowhere near to the degree that producer prices have. That would indicate that you have a widening in profit margins within manufacturing and other sectors. The work that I'm looking at is indicating that we'll see an increase in corporate profits in the second quarter, maybe in the neighborhood of 15% or more. The other thing that a lot of people are missing is that the thing that let us down, which was the massive write-offs in the banking system, as asset prices have risen in the second quarter, a lot of these, that's going to take a lot of pressure off the banks to write off their...
What about some of the unknowns, though? I mean, when I speak with people about banks and potentially what's on their balance sheets, I mean, people say we haven't even begun to see the storm of consumer credit. Let's just pick one area, credit cards. I mean, JP Morgan Chase is a name that comes up that has a lot of exposure. I mean, could this be sort of the second shoe to drop?
Well, I think there is another shoe to drop, and I agree with and another place where I think we're going to have a lot of problems are commercial real estate. But when you look at the rate at which the banks are now reserving for their losses, and then you compare that to the profit margins on their core businesses, which are much higher than they were going into this, you actually get a scenario where the downside case seems to be that the write-offs will pretty much match the increased profitability, so that rather than having these big losses, will be numbers in the worst case scenarios averaging around zero. So that's really, believe it or not, I know that sounds pretty grim to say that there's going to be no profitability in the banking sector, but the reality of that's a dramatic improvement from 2008, and in all likelihood, even if we could get the banking system back towards zero, that would increase corporate earnings overall.
Now, you are a credit expert as well, Scott. I mean, do you see the market rallying, the credit market continuing to rally? I mean, is it based on fundamentals?
I think so.
It seems like.
Yeah. Look, with corporate profitability improving, plus the fact that a lot of people misunderstood the massive credit widening we had in the post-Lehman period. The real issue there was not that credit prices decreased or that credit spreads opened up as a result of defaults. It was liquidity. A lot of liquidity were taken out of the markets with the failure of Lehman and the inability of the investment banks and the banking system to make credit available. And so that liquidity premium has been taken back. But even on a prospective basis, if you look at where credit spreads are today, they're still too wide, and we expect that high-yield defaults will peak somewhere in the 10 to 11% area. And based upon that kind of projection, credit spreads are still wide, and credit is still a bargain.
All right, Scott, thanks so much. Scott Miner there from Guggenheim Partners.